The war in Ukraine has evolved into a grinding conflict of attrition that is simultaneously military, economic, and psychological. On the ground, fighting around key cities and logistical hubs shows that both sides understand the strategic importance of territory, not just as land, but as infrastructure, supply lines, and political symbolism. When Russia pushes towards a city that anchors a railway network or an industrial zone, it is not merely taking ground. It is seeking to disrupt Ukraine's logistics and to demonstrate momentum to both domestic and international audiences. When Ukraine resists or counterattacks, it is fighting for more than a single town. It is defending the credibility of its entire war effort. In this phase of the conflict, losses are measured less in dramatic territorial gains and more in ammunition expenditure, destroyed equipment, and the resilience of mobilized forces. The Russian strategy appears to rely on its larger population and industrial capacity to outlast Ukraine and its Western backers, accepting high casualties to slowly wear down Ukrainian defenses. Ukraine, by contrast, is betting on superior motivation, better use of technology, and continued Western support to compensate for its demographic and industrial disadvantages. This asymmetry is what makes the war a true test of national endurance. Beyond the front line, the conflict has opened a second theater, the maritime and energy domain. Ukraine's attacks on tankers associated with Russia's shadow fleet in the Black Sea are not random strikes. They reflect a deliberate effort to raise the cost and risk of Russia's oil exports, which remain a key source of funding for Moscow's war machine. By using drones and long-range systems to hit ships and port infrastructure, Ukraine is trying to turn geography against Russia, challenging the assumption that energy flows can be shielded from the battlefield. For Russia, the challenge is to maintain export volumes despite sanctions, price caps, and physical disruptions. It has turned to older vessels, alternative routes, and a network of intermediaries willing to handle sanctioned cargoes in exchange for high premiums. This complex and opaque trade is a reminder that economic warfare does not simply shut flows off. It often reroutes them, creating new fragile choke points and governance risks. Insurance, classification, shipping finance, and port access all become instruments of pressure or evasion. The European security order is being reshaped around these dynamics. NATO countries are rethinking force posture, munitions, stockpiles, and industrial capacity. Long-term underinvestment in defense manufacturing has been brutally exposed. As armies discover that high-intensity conflict consumes artillery shells, drones, and armored vehicles at a pace for which peacetime procurement systems were never designed, the result is a wave of new defense spending commitments and efforts to rebuild industrial bases that had been allowed to atrophy. Financial markets respond to this in several ways. First, defense-related equities attract renewed interest as investors anticipate a structurally higher level of demand, particularly in Europe. Second, bond markets must digest the fiscal implications of sustained military spending on top of already large welfare and pandemic-related obligations. For some countries, this raises uncomfortable questions about debt trajectories and the trade-offs between guns and butter. Third, commodity markets treat the Black Sea and associated shipping risk as a factor in pricing both oil and agricultural exports. At the geopolitical level, the war accelerates the move towards a more fragmented global order. Countries that wish to remain non-aligned must navigate sanctions regimes, energy market volatility, and pressure from both Western and non-Western blocs. For them, Ukraine is not only a distant conflict, it is a test case for how resilient or vulnerable they are to disruptions in food, fuel, and finance. In summary, the war in Ukraine is no longer just a story of front lines and offensives. It is a multi-domain contest in which artillery duels, drone strikes on tankers, sanctions, and defense budgets are all interconnected. Any serious analysis of global security and markets must treat Ukraine not as an isolated event, but as a central driver of Europe. Strategic realignment and a key source of long-term uncertainty in energy, fiscal policy, and alliance structures. The situation in Gaza illustrates how modern conflicts blur the lines between military operations, humanitarian crises, and regional geopolitics. Even when a ceasefire or a pause in hostilities is formally in place, the reality on the ground can remain extremely harsh. especially for civilians who bear the brunt of destroyed infrastructure, displacement, and disrupted services. As winter sets in, the humanitarian dimension becomes critical. Millions of people live in overcrowded shelters or makeshift camps, often with limited access to clean water, sanitation, and reliable shelter from rain and cold. In such conditions, the boundary between war casualties and indirect deaths from exposure, disease and malnutrition becomes disturbingly thin. A conflict that originally presents itself as a military confrontation begins to morph into a prolonged public health disaster. International pressure for a more durable ceasefire tends to intensify under these circumstances. Key regional and global actors, including neighboring Arab states, Western powers, and multilateral organizations, seek to balance several objectives at once: de-escalating violence, securing the release of hostages or detainees, protecting civilians, and preserving their own strategic interests. Negotiations are complicated by deep mistrust, domestic political considerations on all sides, and disagreements about the long-term political status of Gaza and the broader Palestinian issue. The opening or closing of border crossings serves as a barometer of both humanitarian access and political shifts. When a major crossing reopens to allow trucks of food, fuel, and medical supplies to enter, it is not only a logistical event. It is also a signal of temporary alignment among key players. Conversely, restrictions on aid or movement often reflect breakdowns in talks or deliberate attempts to exert pressure. For humanitarian agencies, every incremental gain in access is hard-won, and every delay has a direct cost in human lives. From a security standpoint, even a fragile ceasefire can be deceptive. Militias, armed factions, and state forces may use the relative calm to regroup, rearm, and reposition. Intelligence operations, cyber activity, and covert actions continue behind the scenes. Border incidents, rocket launches, or targeted strikes can rapidly escalate into renewed cycles of violence if political frameworks remain unresolved. This is why many analysts describe Gaza as being caught in a conflict trap. Periods of intense violence, punctuated by short-lived lulls that never fully transition into genuine peace. For regional stability, Gaza functions as a flashpoint with symbolic and strategic significance. Escalation there can trigger protests and political pressure in neighboring countries, strain fragile coalitions, and invite external intervention. At the same time, prolonged humanitarian catastrophe risks radicalizing new generations and entrenching narratives of injustice, making future compromise harder. The financial and economic implications are more indirect, but still important. Investors look at Gaza and ask broader questions about Middle Eastern risk. Could the conflict spill over into major energy producers? Will shipping routes be affected? How might regional alliances shift? These questions feed into risk premia on assets linked to the region, from sovereign bonds to equities and currency markets. They also influence the long-term calculus of companies making decisions about investments, supply chains, and insurance. In the global political arena, Gaza has become a litmus test for notions of international law. Human rights and the credibility of multilateral institutions, debates at the United Nations, international courts, and human rights bodies are not merely symbolic. They shape public opinion, diplomatic ties, and over time, the legitimacy of different actors' narratives. This has knock-on effects for soft power. Development aid and bilateral relationships far beyond the immediate theater of conflict. Ultimately, the crisis in Gaza during winter underscores a painful reality in protracted conflicts. The dividing line between military strategy and the deliberate or incidental suffering of civilians becomes dangerously blurred. Any serious response must therefore integrate security, humanitarian, and political dimensions. Analysts and policymakers who focus only on ceasefire negotiations or only on aid flows risk missing how tightly these strands are intertwined, and how failure in one dimension can quickly undermine progress in the others. The Red Sea and surrounding waters have re-emerged as critical theaters in the global security landscape, not because of large-scale naval battles, but because of their role as choke points in international trade. Attacks on commercial vessels, threats to shipping, and disruptions near key straits remind us that in a globalized economy, Maritime routes are both strategic assets and vulnerabilities. When a non-state armed group in Yemen targets cargo ships, or when a state actor seizes an oil tanker near contested waters, the immediate impact is local, but the ripple effects are global. Shipping companies must reassess routes, insurance costs spike, and ports recalibrate their operations. A single incident can lead major carriers to divert vessels around longer, more expensive routes to avoid perceived danger zones. This in turn affects freight rates, delivery times, and ultimately the prices of goods in distant markets. The Red Sea is particularly sensitive because it connects the Indian Ocean with the Mediterranean via the Suez Canal, one of the world's most important man-made waterways. Any persistent threat that makes this corridor appear unsafe can prompt a rerouting of traffic around the Cape of Good Hope, adding weeks to journey times and significantly increasing fuel and operating costs. While modern supply chains are more resilient than they once were, they remain exposed to such shocks. These maritime security risks have both geopolitical and economic dimensions. Geopolitically, they provide leverage to actors who might otherwise have limited conventional power. By threatening ships, laying mines, or launching missiles and drones at sea lanes, smaller players can force regional and global powers to pay attention. They can also complicate the strategic choices of navies that must decide how much force to deploy, under what rules of engagement, and in coordination with which allies. Economically heightened maritime risk introduces a new layer of uncertainty for global trade at a time when businesses are already grappling with the aftershocks of the pandemic, trade wars and reshoring trends, higher insurance premiums, war risk surcharges, and the need for naval escorts or convoys translate into higher costs that may either erode margins or be passed on to consumers. For countries whose imports and exports rely heavily on these routes, this can be especially damaging. Financial markets watch these developments closely, even if they do not always react dramatically to single events. A short-lived spike in risk that is quickly brought under control may have limited lasting impact. But if attacks become frequent, or if key actors explicitly use maritime disruptions as bargaining chips in broader geopolitical negotiations, markets may start to price in a permanent risk premium. One important angle is the role of naval coalitions and multilateral security arrangements. When major powers organize joint patrols or task forces to protect shipping lanes, they are not only safeguarding commerce, they are also signaling their commitment to the existing maritime order. These coalitions must navigate complex legal and diplomatic challenges, especially if they operate near the territorial waters of states that are hostile or ambivalent. Miscalculations at sea, an intercepted ship, a misidentified target, a collision can escalate quickly. Another angle is technological. As drones, anti-ship missiles, and cheap sensor systems proliferate, it becomes easier for relatively weak actors to threaten large, expensive vessels. This asymmetry forces navies and shipping companies to rethink defense and detection. It may also accelerate the adoption of new technologies, from autonomous ships to advanced surveillance and electronic warfare systems. From a long-term perspective, the weaponization of maritime risk reinforces the trend towards diversification of supply chains and routes. Companies and states are exploring alternative corridors over land rail, pipelines, new ports, and logistics hubs to reduce dependence on any single choke point. However, building such alternatives takes time and capital and often runs into its own political obstacles. In conclusion, the Red Sea and similar hotspots illustrate how the security of shipping lanes has become a central dimension of both geopolitics and global economics. The ability of states and international institutions to manage these risks will influence not only freight rates and delivery schedules, but also investor confidence, inflation dynamics, and the wider debate over how resilient or fragile globalization really is. Tensions in East Asia, particularly around Taiwan and adjacent waters, represent one of the most significant latent risks in the global security environment. Unlike active wars elsewhere, the situation here is characterized not by large-scale open conflict, but by sustained gray zone, pressure, military exercises, air and naval incursions, Coast Guard confrontations, and psychological operations that stop short of war while steadily raising the temperature. China's strategy appears to combine military signaling with political messaging. Large-scale exercises around Taiwan, involving fighter jets, bombers, warships, and missile units, are designed to demonstrate the ability to encircle and potentially blockade the island. Frequent crossings of the median line in the Taiwan Strait and incursions into air defense identification zones chip away at long-standing tacit norms. Simultaneously, official rhetoric and political pressure aim to discourage moves in Taipei and among its partners that Beijing interprets as steps towards formal independence. For Taiwan, the challenge is to maintain deterrence and international support without provoking escalation. This involves a mix of military modernization, resilience, planning, and diplomatic engagement. The island is investing in asymmetric capabilities meant to raise the cost of any potential invasion or blockade, such as anti-ship missiles, mobile air defenses, and resilient communications, while also strengthening ties with key partners, including the United States, Japan, and European democracies. From the perspective of neighboring states like Japan and South Korea, as well as Southeast Asian countries, the situation around Taiwan is part of a broader pattern of assertiveness in regional waters, including the East China Sea and the South China Sea. Increased patrols, the construction of military facilities on disputed features, and confrontations between Coast Guard and fishing vessels are symptoms of a shifting balance of power. These states must navigate between deterring coercion, preserving their own claims and economic interests, and avoiding being drawn into a great power conflict. Financial markets are acutely aware that Taiwan is not just a geopolitical hotspot. It is also a critical node in the global technology and semiconductor supply chain. Any serious disruption, whether through conflict, blockade, or even prolonged crisis, would have profound implications for electronics, automotive, and a host of industries that rely on advanced chips. This is why risk premia tend to rise whenever tensions flare, even if no shots are fired. Yet markets also tend to discount prolonged gray zone pressure when no immediate escalation follows. Investors often treat repeated exercises and incursions as noise unless they coincide with other indicators of serious crisis, such as political breakdowns, sanctions, or abrupt military mobilizations. This creates a paradox. The more frequent the incidents, the easier it becomes to normalize them, potentially underestimating the risk of miscalculation. The strategic competition in East Asia also feeds into broader trends: the restructuring of supply chains, the push for friendshoring or de-risking, and the rearmament of regional powers. Japan's decision to significantly increase defense spending and acquire new capabilities, for example, marks a historic shift with implications for alliance dynamics and regional deterrence. The United States, for its part, is deepening security cooperation with partners, conducting joint exercises, and making more explicit commitments about its role in a potential crisis. For analysts and policymakers, the key question is whether this trajectory leads towards a stable balance of deterrence or towards an eventual tipping point. The risk is not just a deliberate decision to use force, but also accidental escalation arising from an incident at sea or in the air, misinterpreted signals, or domestic political pressures on either side. The more crowded and militarized regional waters become, the higher that risk. In sum, East Asia sits at the intersection of strategic rivalry and economic interdependence. Taiwan's status, Chinese military modernization, alliance commitments, and the global importance of semiconductors combine to make it a focal point of both security and market anxiety. Understanding this theater requires looking beyond headline drills and statements to the deeper structural shifts in power, doctrine, and economic geography that are reshaping the region. Around the world, defense spending is rising to levels not seen in decades. From Europe to Asia and the Middle East, governments are allocating more resources to their armed forces. Driven by perceived threats, alliance commitments, and domestic political pressures, this wave of rearmament has obvious security implications, but it also has profound consequences for fiscal policy, financial markets, and the structure of economies. In many Western countries, the post-Cold War peace dividend led to years of underinvestment in defense. Stocks of ammunition, spare parts, and key platforms were allowed to shrink, while industrial capacity for heavy equipment, munitions, and complex systems was consolidated or outsourced. The wars in Ukraine and the growing tensions in other regions have revealed how fragile this posture was. High-intensity conflict demands huge volumes of shells, drones, and armored vehicles, far more than peacetime procurement systems were designed to supply. The response has been a flurry of new spending plans. European states that once saw defense as a low priority are now committing to multi-year budget increases, setting targets for spending as a share of GDP and launching joint procurement programs. The United States, already the world's largest defense spender, is debating how to balance support for allies with modernization needs at home. Asian powers are also increasing their budgets, often citing regional tensions and the need to deter coercion. This surge in spending raises immediate questions about fiscal sustainability. Many of the same governments expanding their defense budgets are also dealing with aging populations, strained healthcare systems, and the costs of energy transition. Public debt levels are high after years of crisis management, from the global financial crisis to the pandemic. Adding large, persistent defense commitments to this mix forces hard choices: raise taxes, cut other spending, or accept higher deficits and debt. Financial markets respond by reassessing sovereign risk. Investors look at debt trajectories, political willingness to implement reforms, and the credibility of fiscal frameworks. For highly rated countries with strong institutions, higher defense spending may be manageable, especially if it supports high-tech industries and jobs. For others, it could contribute to rising risk premia, especially if combined with sluggish growth and weak governance. There is also debate about whether increased defense spending can act as a form of military Keynesianism, stimulating demand and supporting industrial sectors. In the short run, large procurement programs do boost activity in shipyards, aerospace, electronics, and specialized manufacturing. Over the longer term, however, the productivity and opportunity cost of defense investment must be compared with alternative uses of capital, such as infrastructure, education, or green technology. The macroeconomic benefits are not automatic. On the corporate side, defense and security firms are once again in the spotlight. Investors see potential for sustained revenue growth, but they also face ethical and regulatory considerations. Not all capital is willing or able to flow into arms-related industries. Public scrutiny of defense exports, NDUs, and governance is intense. Meanwhile, smaller suppliers in the broader defense ecosystem may struggle to scale up quickly enough to meet demand, given labor constraints and lengthy certification processes. The war finance nexus is further complicated by the role of sanctions, export controls, and financial warfare. Restrictions on technology transfer, dual-use goods, and critical components can reshape global supply chains and influence which countries become hubs for defense-related production. Financial sanctions targeting individuals, entities, or entire sectors integrate war directly into the plumbing of the international monetary system, affecting banks, insurers, and clearing systems. Ultimately, the new age of rearmament forces us to rethink traditional assumptions about the relationship between security and prosperity. For decades, advanced economies could afford to underinvest in defense because their security environment seemed relatively benign. Today, that assumption no longer holds. The challenge is to build credible deterrence and resilience without undermining the foundations of economic stability and social cohesion. Serious analysis of this trend must weave together defense strategy, public finance, industrial policy, and market behavior. It must acknowledge both the legitimate security needs that drive higher spending and the risks that arise when war and finance become more tightly intertwined. The decisions made in this decade about how to arm, how to pay for it, and how to manage the resulting economic pressures will shape not only battlefield outcomes, but also the trajectory of the global financial system in the years ahead.